Welcome back to the deep dive. So if you glanced at the charts this morning, wow, quite the turnaround, wasn't it?
Oh, absolutely. A near flawless escape maneuver, you could say, after the chaos that kicked off on Friday.
Right, this so-called tariff shock. And today we're diving deep into that rebound, specifically this idea of a post-leverage reset. This event wiped out over $19 billion in speculation.
And the analysts are calling it healthy.
Exactly. The most necessary, healthy reset all year, apparently. Which sounds counterintuitive after such a massive crash.
Well, that's the core tension, isn't it? For anyone tracking the price, Bitcoin did claw back aggressively, over 12% up from those weekend lows.
And reclaimed that really key $115,000 level. The initial panic just reversed.
So our mission today isn't just about the bounce itself. It's about understanding why people are calling this crash healthy. What does it tell us about institutional conviction, market structure?
Or maybe what parts of the system are actually working and which ones aren't. What does this post-leverage reset really mean moving forward?
Precisely. We need to look at what survived this huge stress test, what's on sure footing now, and where did we see real fragility?
Okay, let's start with the bounce itself. The mechanics of it. It was pretty vicious. Bitcoin dipped below $105,000.
And then snapped right back. Pushed the whole sector's market cap back above $3.89 trillion. That's quite a swing.
You don't see that kind of volatility in traditional markets very often.
No, you don't. Now, a short squeeze probably helped that initial jump, but the real story here, the fundamental driver, was the leverage getting flushed out.
And that brings us back to the healthy reset idea.
Exactly, and the proof, you really find it in the derivatives market.
Right, where all the speculative bets live. What did that data show? Because that must have been where the pain was concentrated.
Oh, it was a bloodbath. Open interest, that's the total value of all the outstanding futures and options contracts, it plummeted nearly 40% overnight.
40%? That's staggering.
It is. For Bitcoin and Ether options, OI was basically cut in half in just 48 hours. So by purging the system of all that borrowed money, that over-leveraged speculation...
You remove the instability.
You remove a huge source of structural instability, yes. The market, technically speaking, is probably on sounder footing now than it was just a week ago.
Okay, but hang on. A 40% drop in open interest. Doesn't that signal a massive loss of confidence? It sounds less like a healthy reset and more like, well, like the derivatives market almost died.
It probably felt like that for many traders, no doubt. But think of it this way. It clears the decks. The market was kind of clogged up with cheap leverage chasing quick profits.
Those players got wiped out.
Forcibly removed, yes. And the recovery itself shows that conviction didn't just evaporate. It seems like it rotated and maybe consolidated.
And we saw that rotation pretty clearly, right? There was a definite flight to quality.
Absolutely. Bitcoin led the charge back up. Ethereum was right there with it, up around 11%, holding over $4,100.
But most of the smaller tokens, they really lagged behind.
And that's the key signature. It suggests sophisticated, large, well-capitalized players stepping in. They weren't just blindly buying everything.
They were targeting the blue chips.
Exactly. The assets they see as having the best risk-adjusted return, especially once that immediate macro fear pulled back a bit, this kind of targeted buying, it signals a new dynamic.
Like an institutional floor. A sort of buyer of last resort below certain levels.
That's what it looks like, a strong institutional bid that helps stabilize the whole structure. It's a sign of maturity, arguably.
And we actually have some concrete examples of corporations showing that long-term view even during the panic.
Right, like MRA Holdings.
Yeah.
They picked up another 400 BTC during the dip. That's, what, over $46 million?
Yeah, and Strategy had bought another 220 BTC in the week before the crash. They were basically buying into the fear.
Which tells you they see these drops as noise, temporary blips against a much bigger, longer-term adoption trend.
Okay, so that covers the internal cleanup, the leverage purge. But none of that recovery happens in a vacuum, right? The external environment had to give some kind of all-clear signal for those big buyers to feel confident stepping back in.
Absolutely critical. The macro picture had to shift.
So what was the main catalyst there?
It really seems to be the sudden easing of tensions in the U.S. China trade situation. That was the big overhang.
Ah, the tariff shock trigger.
Exactly. And the de-escalation apparently started in Beijing. The People's Bank of China, the PBOC, they set the official rate for the yuan on Monday, much stronger than expected, strongest since late 2024, actually.
And the market read that as
a deliberate signal, A move to stabilize things to show they weren't looking to escalate the trade fight further, especially through the currency markets.
And then Washington seemed to pick up that signal almost immediately.
Right, you saw a clear shift in tone. President Trump, VP Vance, both put out more conciliatory messages, talk about being open to a deal.
Trump's Truth Social post. Don't worry about China, it will all be fine.
Yeah, that kind of rhetoric. It was this synchronized step back from the brink, really. It confirmed that the worst-case geopolitical risk, that tariff shock scenario, was probably off the table, at least for now.
And that external all clear was the green light needed for the internal demand to kick in.
It seems so. It unleashed the buyers who were likely waiting on the sidelines.
And amidst all that chaos, something else pretty significant happened. Almost under the radar, but maybe more important long term.
You're talking about Luxembourg.
Exactly. Luxembourg's sovereign wealth fund. They publicly announced they've allocated 1% of their portfolio to Bitcoin through regulated ETFs.
Which is huge. I mean, forget the short-term price swings for a moment. This is a sovereign wealth fund, a Eurozone sovereign wealth fund, putting state capital into Bitcoin.
First public disclosure of its kind in the Eurozone.
Yes. It just reframes Bitcoin. It moves it beyond just a corporate treasury asset, like for MARA or strategy, and puts it into the category of a potential strategic reserve for nations.
That's a powerful signal, especially coming from a major financial center like Luxembourg.
Oh, absolutely. It sends a message to every other conservative public fund manager out there. It's a massive stamp of legitimization.
Okay, so we have validation from institutions, even nations now.
Yeah.
Let's pivot to viability, though. Because this crash wasn't just about price, it was a massive stress test for the whole market's plumbing.
A live fire stress test, as you put it. And yeah, it exposed some really stark differences in how different parts of the system held up.
Especially the difference between centralized and decentralized systems.
That was the clearest takeaway, I think. We saw real fragility, acute problems in the centralized world.
Which exchanges are we talking about?
Pretty much all the big ones, Binance, Coinbase, Robinhood, they all reported operational issues right when volatility peaked.
What kind of issues?
Users getting locked out of accounts, stop-loss orders failing to trigger or just disappearing, frozen withdrawals. The works. Coinbase even put out a statement confirming degraded performance. Not what you want to hear when the market's dropping like a stone.
And the consequences of those failures. Did we see material impacts?
We certainly did, especially on Binance. They had some serious issues, including stable assets depegging.
Right.
One, USDE, apparently dropped to like 66 cents briefly.
Wow. And Binance had to.
They had to acknowledge the system failures and ended up paying out around $283 million in compensation to users who got burned because their systems couldn't handle the load.
$283 million. That's not insignificant. It's a real financial hit, plus the damage to trust.
Absolutely. A clear demonstration of the fragility inherent in some of these centralized architectures under extreme stress.
Okay, but here's the fascinating flip side. How did the decentralized infrastructure fare during this?
That's where the story gets really interesting. Core DeFi protocols, they performed, well, pretty much flawlessly.
Even with the huge volumes and volatility.
Seems so. Take Uniswap, the biggest decentralized exchange. It processed nearly $9 billion in trading volume in a single day, a record. And according to reports, zero degradation, zero downtime, no frozen funds.
It just worked.
It just worked. And look at Aave, the decentralized lending platform. It automatically liquidated a record $180 million worth of collateral in just 1 hour during the crash.
Automatically liquidating.
Yes, the smart contracts executed exactly as they were designed to. No human intervention needed, no circuit breakers tripped, no manual overrides. It just autonomously managed the risk based on its code.
So you've got this stark contrast. Centralized systems are buckling, costing users and the platform hundreds of millions, while decentralized systems are processing record volumes under immense stress without a hitch.
That's the empirical data point right there. It's powerful, real-world evidence supporting the argument for the structural resilience of DeFi. For institutions worried about counterparty risk, operational risk, this is a major data point.
Yeah, that kind of performance under fire must resonate with capital allocators thinking about the future infrastructure of finance.
It absolutely should. It fundamentally changes the risk assessment for engaging with these different types of platforms.
Okay, let's shift gears now and look purely at the technical picture for the near term. This reset seems to have carved out some pretty clear new lines in the sand. What should traders be focusing on right now?
Yeah, the short-term structure is much clearer. Immediate support seems to have formed around 113,500 to $114,000. That lines up with the 23.6% Fibonacci retracement level of the recent move.
Okay, that's the floor for now. What about resistance? Where's the ceiling?
The key immediate hurdle is that big psychological number, $120,000. Reclosing that convincingly would be a strong bullish signal.
And the absolute must-hold level, the major support.
That remains the low point of the crash itself, somewhere in that $100,000 to $107,500 zone. Breaking back below that would be very negative.
Right, so that's the short-term bullish setup, but we need to balance that, right? Look at the bigger picture, the higher time frames. There was some technical damage done before and during the crash.
Oh, absolutely. You can't ignore that. We saw some classic topping signals right before things fell apart.
Like what?
Well, there was a shooting star candle pattern, which often signals rejection at a high. That was followed immediately by a bearish engulfing candle, which suggests sellers really took control. Pretty textbook reversal signals, actually.
And momentum indicator.
Also looking soft. The daily RSI, the relative strength index, it fell below 50, which is often seen as bearish territory. And the MACD indicator registered a bearish crossover.
Okay, so for listeners maybe not deep into charting, that MACD crossover basically flags a potential shift from upward momentum to downward momentum.
Exactly. So until some of that technical damage on the higher time frames gets repaired, the caution flag is still up. The argument could be made that, for shorter-term traders anyway, selling the rips might be better than buying the dips for now.
So a moment for maybe critical observation rather than just jumping back in with both feet.
I think that's prudent, yes. Healthy skepticism is warranted.
Okay, finally, let's talk about the digital gold debate. This crash was like a perfect real-world laboratory test for that narrative, wasn't it? How did Bitcoin actually behave when risk assets were getting hammered?
The results were pretty unambiguous, I'd say. Bitcoin acted much more like a high-beta risk-on asset, not like digital gold.
Meaning it moved with stocks.
Pretty much in lockstep, especially with tech stocks. Its correlation with the Nasdaq Q100 index has been really high this year, like 0.87 or so. And when geopolitical fears spiked and stocks dumped, Bitcoin dumped right along with them.
And how did actual gold perform during that same period?
Gold did exactly what you'd expect a traditional safe haven asset to do. It performed its defensive role perfectly. As risk assets sold off, gold soared, hitting a new record high near $4,100 an ounce during the peak fear.
So a very clear divergence.
Yeah.
Bitcoin acting like volatile, gold acting like, well, gold.
Precisely. The data from this event strongly supports the Bitcoin as risk-on tech asset view, not the digital gold one, at least in this kind of macro shock.
Which is fascinating, because even as it acts like a volatile tech stock, the traditional finance industry is building increasingly sophisticated tools to manage the exact volatility.
That product innovation is moving incredibly fast. It's a key part of the maturation story. You mentioned Calamos Investments launching those new structured protection ETFs.
Right, the laddered Bitcoin ETFs.
Yeah, offering continuous Bitcoin exposure, but with built-in downside protection levels, 100%, 90%, 80%. That tells you the industry focus is shifting. It's moving beyond just providing basic access.
And now it's about building tools for more conservative investors. Tools to actually manage the risk and volatility inherent in Bitcoin.
Exactly. It's about making it palatable, making it fit within traditional portfolio construction, even with its volatility.
Okay, so let's try to synthesize all this. Pulling back, the big picture seems to be that the market faced down a massive historic stress test.
And it navigated it, arguably successfully. The most dangerous internal risks, primarily that excessive leverage, got flushed out. The system is cleaner internally now.
Which means the main concern for investors shifts, right?
It shifts outwards. The paramount risk now looks primarily external and macroeconomic, especially sensitivity to geopolitics, like we saw with the U.S. China tensions. Bitcoin is now firmly integrated into the global financial system.
And that means it inherits global macro risks.
That comes with the territory, yes.
So for you, listening to this and trying to navigate this post-reset environment, what are the absolute critical signals to keep an eye on going forward? What's the checklist?
Okay, 3 key things, I think. First, spot ETF flows. Keep a very close eye on the net flow data for the U.S. spot Bitcoin ETFs. That's going to be the clearest, most definitive referendum on whether institutions are truly buying this dip with conviction.
So follow the institutional money via the ETFs. What's second?
Second, Watch how the derivatives market rebuilds. We want to see a slow, steady rebuilding of open interest. And watch the funding rates. That's basically the cost to hold a leverage long position. If those rates shoot back up into highly positive territory really quickly,
That's a warning sign.
it's a warning sign that speculative excess, that same leverage problem, might be creeping back in too fast. Slow and steady is healthier here.
Okay, ETF flows, slow derivatives rebuild. What's the third?
Third, geopolitical tone. Pay close attention to the rhetoric, especially between the U.S. and China. Any significant re-escalation, any sign that the all-clear was premature, would immediately challenge the current bullish macro outlook. The market is clearly very sensitive to this right now.
Got it. ETF flows, derivatives rebuild pace, and geopolitical stability. So here's a final thought, something for you to maybe chew on as we wrap up.
Right.
We have this clear empirical evidence now from this crash. Bitcoin's price action. It looks and behaves a lot like a volatile technology stock, highly correlated to the Nasdaq.
Yep, the data confirm that quite starkly.
But at the exact same time, you have the world's biggest, most sophisticated financial players, the BlackRocks, the Fidelities, the Calamos, building incredibly complex tools like those structured protection ETFs, specifically designed to tame and manage that exact tech stock-like volatility.
Right. High risk, but increasingly manageable risk is the message they're sending with these products.
So what does that dual reality mean? Bitcoin acts risky, but the institutions are building sophisticated shock absorbers for it. What does that imply for the long-term, maybe inevitable inclusion of Bitcoin in things like standard retirement funds? 401ks, pension portfolios. Think about that intersection of inherent volatility and engineered stability as the market continues to evolve.